The hedging return-seeking portfolio approach splits the assets into two parts. The first is the hedging portfolio. The second is the return-seeking portfolio. The hedging portfolio is designed to offset liability cash flows. It does this through cash flow matching, duration matching, or immunization. The hedging assets must be driven by the same factors that drive liability returns. This keeps the asset and liability values aligned over time. If liabilities are linked to inflation, the hedge uses index-linked bonds or other instruments that track inflation. If liabilities are sensitive to interest rates, the hedge uses fixed-rate bonds to match that exposure. Any surplus capital, if it exists, goes to the return-seeking portfolio. This portion is managed independently from the hedging assets and aims to generate higher returns. The basic two-portfolio approach is used when the fund has a positive surplus. That means the funding ratio is greater than 1. Most of the capital is placed in the hedging portfolio. The goal is to secure future liability payments with as little risk as possible. So they will hedge 100% of the liabilities with the assets. The remaining assets go into higher expected return investments. These can include equities or alternative assets. For example, a pension plan has $200 million in assets and $150 million in present value liabilities. Under the basic approach, $150 million of the assets will be allocated to the hedging portfolio to match the liabilities. So we would hedge 100% of the liabilities with the assets. The remaining $50 million, which is a surplus, is allocated to return-seeking assets such as equities or corporate bonds. So in terms of relative to this $200 million of assets, okay, so if you take 150 million divided by 200 million, okay, so we are allocating 150 over 200, which is 75%. So in this case, 75% of the assets have been allocated to hedging 100% of the liabilities, and the remaining 25% will be allocated to return-seeking assets. The basic approach is more suitable for conservative investors, such as insurance companies. It also works well for overfunded plans that want to minimize the risk of not being able to meet future liabilities. There are two main limitations. First, when the funding ratio is below 1, the investor cannot implement a full hedge unless new contributions create a surplus. Second, a true hedge may be unavailable for certain risks, such as weather-related losses. In those situations, investors must rely on imperfect instruments and face basis risk. There are two common variants of the two-portfolio approach. A partial hedge allocates less capital to hedging, so the portfolio can pursue higher expected returns. A dynamic hedge increases the hedging allocation as the funding position improves. These variants do not fully hedge liabilities at all times. They are most useful when the sponsor has flexibility to make future contributions if needed. In this example on partial hedge, the pension plan has $100 million in assets and $80 million in liabilities. A full hedge would place all $80 million in the hedging portfolio. Under a partial hedge, the plan may choose to hedge only $60 million. The remaining $40 million is invested in return-seeking assets instead of $20 million under a full hedge. This approach raises expected returns, but leaves $20 million of liabilities unhedged. In this example on dynamic hedge, the plan has $200 million in liabilities and follows a simple glide path rule. If the funding ratio is below 1, it hedges 50% of liabilities. If the funding ratio is between 1 and 1.1, it hedges 70%. If the funding ratio exceeds 1.1, it hedges 90%. Now look at how the hedge changes as assets increase from 180 million to 225 million. At $180 million in assets, if you take 180 divided by liabilities 200, the funding ratio is 0.9. So if it's 0.9 is below 1, so we hedge 50% of the liabilities. So that would be $100 million. Now at $200 million of assets, and if you take 200 assets divided by 200 liabilities, so funding ratio is 1, which falls in the range of 1 to 1.1. So we hedge 70% of 200 million, which is 140 million. So if the assets go up to 210 million, the funding ratio will be 1.05, which is 2.210 divided by 200. So this is 1.05 is still within the range. So we would still hedge 70% of the liabilities, which is 140 million. And if the assets go up to $225 million, okay, the funding ratio will be 1.125, okay, which is 225 divided by 200. And 1.125 is greater than 1.1, so in this case we would hedge 90% of the liabilities, so that would be $180 million. So this shows how the dynamic hedge would slowly or incrementally increase the amount of liabilities hedged as the funding ratio increases.